Today we're diving into Trump's big beautiful bill of 2025 and how it has transformed a certain dividend ETF into a gold mine. You might be thinking, how does politics affect my investments? Stick around as we break it down step by step. In 2025, Trump's new legislation aimed to stimulate manufacturing, tech, and dividend-heavy industries. Why does this matter to a dividend ETF? It's all about how ETFs work and the companies they hold. High-yield dividend ETFs are like the VIP section of investing. They pay you consistently while still offering growth potential. The big beautiful bill provided tax incentives and direct benefits to companies with strong dividend payouts. When the bill passed, markets reacted quickly. Companies in the ETF saw increased investor confidence and better earnings projections. This created a perfect storm for dividend growth, making the ETF a potential gold mine for investors. This ETF isn't just any dividend fund. It holds companies with long-term stability, high yields, and growth potential. The magic is in compounding. Reinvested dividends create serious wealth, especially with legislative support. Trump's bill matters because it offers tax breaks on corporate dividends and bonuses for consistent payouts. For investors, this means stronger foundations for your dividend ETF, potential dividend increases, and better market performance. Now let's talk numbers, because this is where it gets concrete. Before the bill passed, this dividend ETF yielded around 6% annually. After the legislation, analysts projected yields climbing to anywhere between 8% and 10%, depending on reinvestment strategies and market conditions. That's not a small jump. Compound that over multiple years, and you're looking at returns that could rival or even surpass more volatile investment strategies. The key here is consistency. While tech or growth stocks might fluctuate wildly, dividend ETFs provide a steadier, predictable income stream, and now it's enhanced by government policy. Another crucial point is diversification. High-yield dividend ETFs often spread their holdings across multiple sectors: utilities, real estate, consumer staples, and even some tech firms. This spreads risk while maintaining steady income. And with the big beautiful bill favoring dividend-paying companies, this ETF sectors are likely to benefit simultaneously. That's why many investors are seeing this as a low-risk, high-reward opportunity. Let's zoom in on a few of the top holdings. You've got giants in energy, consumer goods, and banking, all of which pay above-average dividends. Energy companies benefit from tax credits and subsidies. Banks gain from regulatory clarity, and consumer goods firms see increased consumer spending from economic incentives. When these companies thrive, the ETF thrives. And here's the kicker. Dividends from these companies are often paid quarterly, giving investors a steady income stream while the ETF's value grows. You might be wondering, should I jump in now? Timing is critical. The initial surge occurred immediately after the bill's passage, but there's still room for growth. The first wave of gains often comes from market hype, but sustained growth depends on company performance, continued legislative support, and broader economic conditions. If these factors remain favorable, the ETF could continue to outperform traditional dividend funds. Now, let's talk about risk, because no investment is without it. Political changes, interest rate shifts, and global economic trends can all affect ETF performance. While Trump's bill provided a tailwind, investors should remain cautious. Diversification, reinvestment strategies, and monitoring market trends are crucial. A high-yield ETF can be a powerhouse, but it requires attention and patience. What's particularly interesting is how this ETF compares to traditional savings or fixed income options. Bank CDs or government bonds might offer safety, but their yields pale in comparison. With the Dividend ETF benefiting from policy support, you're looking at a combination of stability and superior returns, a rare combination in today's market. For long-term investors, this is gold. Literally. Now let's talk about strategy. Many investors are using a reinvestment plan to maximize gains. By reinvesting dividends automatically, they're compounding wealth faster than just collecting cash payouts. Combined with the upward push from Trump's bill, this strategy has turned into a formidable wealth-building machine. Even conservative investors, who might have shied away from riskier assets, are finding this ETF appealing because of its combination of yield, policy backing, and diversification. Another aspect to consider is market psychology. When investors see policy-driven growth, confidence rises. This ETF's price movement isn't just about fundamentals, it's also about sentiment. When more people buy in, prices rise further, creating momentum. And because this ETF is already paying high dividends, early investors can enjoy both capital gains and passive income simultaneously. It's a double benefit that doesn't come around often. So what does this mean for you as an investor? First, it's a reminder that policy and legislation can have a direct impact on your portfolio. Staying informed is critical. Second, dividend ETFs offer a unique combination of stability, income, and growth, which is amplified when government policies favor them. Third, reinvesting those dividends and maintaining a long-term perspective can generate wealth that outpaces traditional strategies. And here's the thing about timing. While the ETF surged immediately after the bill, its long-term potential comes from sustained growth. Dividend-paying companies tend to be more resilient during economic downturns. Their cash flow allows them to continue payouts even in turbulent times. This resilience makes the ETF a defensive play with upside potential, a combination that savvy investors love. Let's break down the math in simple terms. Suppose you invest $10,000 in this ETF with an 8% yield. That's $800 annually in dividends. Reinvest those dividends over 10 years, factoring in modest price appreciation, and you could see your initial $10,000 grow to nearly $20,000 or more. Now, imagine starting with a larger portfolio or adding to it regularly. The compound. Receiving regular dividends creates a sense of accomplishment and security. You're literally getting paid to hold an ETF. When dividends rise, consumers and investors benefit. Companies reinvest profits and markets gain confidence, promoting a thriving ecosystem. Trump's Big Beautiful Bill of 2025 reshaped the dividend landscape. The ETF we're watching exemplifies wealth creation through legislation. Keep an eye on policy developments, monitor ETF performance, and consider your reinvestment strategy. Don't ignore market signals. The sectors included in this fund Utilities, energy, financials directly benefited from policy moves, spreading risk across the portfolio. Reinvesting dividends buys you more shares, leading to astonishing compounding growth over time, especially with legislative support. Market psychology plays a key role in momentum. The positive sentiment around the big, beautiful bill boosted dividend companies. Dividend ETFs are more resilient during downturns. They pay dividends even amidst stock price fluctuations, offering a buffer for investors. High-yield ETFs often have pricing power, allowing them to pass cost increases to consumers, acting as a hedge against inflation. Investing $50,000 in this ETF with an 8 to 10% yield results in $4,000 to $5,000 in dividends. Reinvesting those dividends can double your portfolio in a decade. Legislative momentum mirrors historical shifts. Past stimuli, like the 2003 dividend tax cut, rewarded shareholders, enhancing consumer confidence. Post-bill, large-cap companies increased payouts. The energy sector now offers higher distributions, attracting capital flows to these equities. In the financial sector, banks revised payout guidance upward. This marked an uplift in valuations, while signaling healthy market capital inflows. The bill incentivizes tech companies to provide dividends. This adds stability and recurring income to traditionally volatile sectors. Capital rotation is evident as institutional money shifts to dividend equities. This influx accelerates momentum and supports price appreciation. Another major factor is currency strength. The bill's emphasis on domestic manufacturing and repatriated profits has strengthened the US dollar in the short term. For dividend investors, that can mean two things. International holdings in the ETF may see temporary currency pressure, but US-based dividend companies gain purchasing power for imports and capital goods. In effect, stronger domestic fundamentals bolster the ETF's core holdings, while international exposure adds long-term balance. This dynamic interplay between policy, currency, and corporate health is what separates a transient rally from a structural shift. Let's touch on a topic that often flies under the radar: corporate cash deployment. With the bill reducing taxes on retained earnings and incentivizing capital investment, companies are more willing to both grow and distribute. Many of the ETF's holdings have announced dual-track plans, ramping up dividends and reinvesting in automation, renewable infrastructure, and AI integration. This isn't just a dividend story, it's a productivity story. As firms become more efficient, margins expand, profits rise, and dividend sustainability improves. Long-term investors benefit twice: first, through consistent payouts, and later, through capital gains driven by enhanced profitability. Now, consider behavioral finance. The human side of investing is powerful, and dividend ETFs excel at satisfying psychological needs. Regular income provides emotional reinforcement. It feels tangible, reliable, and rewarding. Investors are more likely to stay invested through volatility when they see quarterly cash arriving. That's why dividend ETFs often outperform growth funds over the long haul, despite slower capital appreciation. And when a major policy like Trump's bill amplifies that income flow, it strengthens investor conviction. The result? Lower panic selling, smoother price trajectories, and compounding stability. We also have to discuss tax efficiency from a structural standpoint. ETFs already have built-in advantages due to in-kind creation and redemption mechanisms that minimize capital gains distributions. Combine that with reduced dividend tax rates, and investors gain one of the most efficient vehicles for after-tax income. For retirees or income-focused portfolios, this is transformative. Instead of chasing high-yield bonds or exotic instruments, they can hold a diversified equity basket that behaves like an income generator with growth potential on top. One of the lesser noticed but critical consequences of the Big Beautiful Bill is its impact on corporate governance. By rewarding transparency and consistent dividend histories, the bill implicitly encourages better management discipline. Boards are incentivized to maintain steady cash flows, limit reckless acquisitions, and prioritize shareholder value. Over time, this could shift corporate culture towards sustainability and predictability, two pillars that dividend investors cherish. For the ETF, that means less exposure to sudden dividend cuts and more exposure to firms with long-term strategic clarity. Let's take a brief look at historical analogs. In the early 2010s, when several Asian economies introduced corporate tax incentives to encourage higher dividends, market capitalization of dividend-paying firms surged 40 to 60% within 3 years. The U.S. now appears to be in a similar phase, except on a much larger scale. Analysts already forecast that total S&P 500 dividend payouts could hit record highs within the next 2 fiscal cycles if the current legislation holds. For our ETF, that's effectively a rising tide lifting every ship in its portfolio. As American dividend ETFs attract capital, other nations may respond with competitive tax reforms to retain investment inflows. This pattern could spark a worldwide dividend renaissance, redefining portfolio construction strategies for decades. If fiscal deficits widen due to tax cuts, long-term interest rates could pressure equity valuations. Position sizing, sector balance, and periodic reevaluation are essential to protect gains amidst these shifts. As capital shifts from growth to income-producing assets, the Big Beautiful Bill could accelerate this transition. Investors prefer consistent income streams. Monthly paying ETFs are rising to meet this demand. When dividend income rises, consumer sentiment tends to follow, boosting demand and sustaining corporate profits. Thanks for watching. Stay informed, patient, and strategic to turn opportunities into real wealth.